Hi, this is Jeffrey Cohen, Chicago Quantum. How are you? It's November 5. Glad to have you listening. Your attention, your time is very valuable to us, and we understand it. So thank you very much. So this week, we have a lot to talk about. It's November 5th. Markets are a little different this week. Things are a little interesting. More of a target-rich environment. To be honest, I was expecting the market to be down. I thought that the Fed tapering of interest rates was going to have a big effect. What they've announced, just to let me set the table a little bit. And I'm going to pop up 3 stocks here. These are stocks that we own. And this is what they call a book viewer by NASDAQ. It costs $15 a month for an individual. It's terrific. Love it. Because you get to see all the orders and stuff. And so I want you to know what I look at. I want you to see what I see. And I want you to be valuable. I want it to be valuable to you. Now here's some notes. We do a lot of stuff with notes. You notice here I wrote a note. Do some due diligence on Merck and Tenneco. Now Tenneco is a Lake Forest company. They make auto parts. It's pretty good parts. I fix an old Camaro, so I know about parts. And down like 14% today. They had earnings. Merck is down because Pfizer's up. Pfizer came up with a new pill. It keeps you out of the hospital. It keeps you from dying with COVID. So, honestly, I don't know. I see all this, and I'm constantly amazed at how a little bit of news, a little headline can make a stock as large as Merck, move 8% in a day. So I just don't understand. So we're learning now. We're learning. It's target-rich environment. If a stock moves 8% in a day, you can make money. So let's set the table, okay? So I'm gonna just go. You're gonna watch me drive, basically. So we're gonna take a look at the Federal Reserve taper. And let's see what they, it's frustrating because the Fed doesn't actually publish what it said it would do. So here it is. So frustrating when people want to sell you something. All right. So the Fed's going to begin tapering the pace of purchases. Today it buys $120 billion a month. So instead it's going to buy $15 billion less, or $105 billion in November. In December, it's going to buy $15 million less. On and on and on until next year, number 0. So when we've looked at the growth in M2 money supply, it's been running approximately $120 billion a month. So the Fed is responsible for all the growth in the money supply. First off, that tells you inflation. I don't know. If the Fed is printing money, and that's the money that's being added to the money supply, that tells me this might be a self-inflicted wound. So that's good news if you're worried about inflation. Now, if you're worried about oil prices, that's a different issue. So personally, I look at oil prices. I think oil prices are something that hurts the regular person, the common man. And why is that? Well, I saw a chart once. I don't know if I believe it or not, but it's good enough for government. And what the chart said was that when the price of gasoline goes up at the pump, the amount of money that people have to spend for gas in a week, because usually they don't have a choice. They drive to work, okay? They drive around with their families. And so the money that they spend on gasoline comes dollar for dollar out of their spending on other products. So we're going to take a look for the last year. What has oil and gas done? So oil and gas was, and the absolute number doesn't really matter, but a year ago it was 37 a barrel. Now it's 81, so it's double. So let's just go with that. More than double, right? In fact, if you go back further, it was even lower, but double, okay? So if an average family, let's say, spends $50 a week on gas, now they're spending $100. So that means $50 a week less to spend at the grocery store, the movies, clothing, furniture, a new car, anything. $50 a week's a lot of money for most people. That's $2,500 a year. That could be the difference between a new wardrobe and no wardrobe. That could be the difference between throwing a party and no party. So inflation would imply, though, that people got more money coming in. They're replacing the $2,500. I'm not sure I see that. Now, what I do see wages going up. ATI Physical Therapy, the stock, we were long this week, and then we sold it for a nice profit. But the reason the stock dropped there is the cost of the physical therapists went up. And it's hard to hire. Cost of teachers, cost of people that Amazon's hiring is going up. Wages are going up. And they might have actually gone up $2,500, which would be nice for most Americans. That's $1 an hour, buck and a quarter an hour. But truthfully, if wages went up $1 and a quarter and the price of gasoline went up $1 and a quarter, equalized, 2,000 hours a year working, then we didn't get anywhere. Okay, there's no inflation when that happens. So what I think is really happening is there's oil and gas. And that's self-inflicted wound too. First thing President Brandon did, let's go Brandon, is he canceled the XL pipeline. First thing he did, and then he said we're going to be a green economy, we're going to transform, it's going to be great, we're going to use switchgrass, and we're going to use solar and wind, and we're going to have... what did he say? Gerbils on a treadmill, and you're going to make electricity. We're going to have more nuclear. Now, I'm a big supporter. By the way, Chicago Quantum supports nuclear power. But he said, no more oil and gas. Let's jack the price up. Let's stop the pipelines. Stop the drilling. Make the price so high, people are going to switch to electric cars. Okay. But, one of the stocks that we're long is Workhorse, because Workhorse makes electric trucks. I like electric trucks. I think it's great. I think for short haul, a bakery can deliver, a laundry service, mail delivery, package delivery, delivering pizzas. This is 250 miles or less. You can charge the battery overnight. You're good to go. I like the truck model for electric vehicles. But the Workhorse doesn't ship any right now because the electricals aren't mature enough and they got a recall and it's hard to scale up, right? So you double the price of oil and gas. All you really did in that year is you punished the working people. And the stock prices of consumer goods companies and consumer services, your telcos, your food and beverage, even retailers, the stocks are down. I know because the model picks them because they're flat, but they used to go up. And so they're good, strong companies with solid fundamentals. But they're flat, they're declining, they're consolidating because people don't have money to spend. So I think this is a self-inflicted wound, oil and gas. So when I look at inflation, I see there's the oil and gas issue. And then there's all the other issues. Who's printing the money? The Federal Reserve Bank tapering its $120 billion or $1.4 trillion a year of extra money. That's your inflation right there. So let's take a look, because Jeff, let's do a fact check. You might be full of baloney here. So we're going to type Fred for Federal Reserve Bank St. Louis Research Department, and then we're going to look at M2. And it's going to show up Fred M2SL. Fred M2SL. Not hard to find. This is all public data, right? Not crazy. And we take a look at the growth in the money supply. Now you look, and it looks like this nice gradual growth. Now money supply is supposed to grow with the economy. So when it goes from $4 trillion in 1997 to $8 trillion in 2008, 11 years, double, law of 72, that's about 6.5% growth rate. It's about right. It kept up with the growth, Now, when did it double again from 8 to 16? So you got 2008. 2020. That's 12 years. I know growth slowed down. So 72 divided by 12 is like 6%. Okay. 12, yeah. So it's about 6% growth economy. All right, fine. I got that. But now we went from 16 to 20. We went more. 16 to 21. It's 5. It's about a third in a year. So that's not economic growth driven. That is, I don't know what the Fed was doing. They were doing something there. So let's take a look. Let's zoom in. Love this. But it has a little slider on the bottom. You could zoom in. You can really focus. So let's take a look at the last year or so. So what's nice about this website, and thank you, Fred. Thank you, St. Louis Federal Reserve Bank. You guys are amazing. I love you guys. Okay, we're 21 trillion money. M2 is like coins and cash and fast money, checking deposits, plus another tranche of money that's slightly less liquid. So let's say money markets are in, CDs that are small, just different. I think commercial papers in there, like stuff that you could turn over. It's not immediately cash in your wallet, but it's fast money, right? So fast money, 21, 20.8. That's 120 billion. 20.5. That's actually less. Oh, 20.4, 20.5, 20.8. So you've had 3 months, 4 months, pretty slow, 20.4. But before that, 20.1. No, I'm wrong. Those are trillions. I'm so sorry, people. That's 120. That's 220. That's 100. That's 20. That's 270. All right, so it looks like they're a little off. It's a little off, but it's about 120 a month, 120 billion a month. So the Fed's creating all this. It's terrible, right? That they're just creating inflation. That's terrific, right? Now, what's been saving the Fed? So this is something I, Jeffrey Cohen, believe in. I went to University of Chicago, economics department, had 5 Nobel Prize winners teaching me. And one of them said something very smart. He said, velocity of money, Jeff. You ought to pay attention to that. It was Robert Lucas Jr. So we're going to go back to Fred. Velocity, M2. So Jeff, what is this? First off, what is the velocity of money? The velocity of money is the amount of times in a year that the money can get spent or moved around, right? And so if you look historically, you run about 1.8. So a dollar isn't a dollar. A dollar is $1.80. And that's because if I give you $1, here's my dollar, and I lend it to you. I'm the Bank of Montreal, and I lend it to you, Montreal Construction Company. Well, you're not taking all the money and spending it. You put it in the bank. Now, you put it in the bank. Let's say you put 90 cents in the bank. Well, the bank's like, ooh, I got a deposit, 90 cents. Budvar. I'm going to lend 85 cents of that out. So I have 90 cents in the bank, 85 cents. Oh, 85 cents in the bank, or maybe they put 70 cents in the bank. I'm going to lend 50. So I got 90, I got 80, I got 50. Next thing you know, I got $1.80 extra floating around. So the point is that's normal. $1 is $2 is $3 even. It's been as high as $2.20. This is economy wide, right? But it's almost always since the 60s, since the late 50s, has always been around 1.6 to 1.9. Okay. And then all of a sudden it collapsed into 2020. So what happened was there was a deleveraging in 2008 with the housing crisis. Housing crisis where people thought it was easy. You had mortgages. You had trillions of dollars of mortgages. And then instead of letting housing prices come down normally, you know what? You bought 5 houses, you lost money. I'm sorry. But instead they bailed everyone out. And now the velocity of money went from 1 point... What was it in 2008? When the crisis hit, it was about 2. Okay? Borrowed money, doubled up. It's great. By the end of the crisis, it was 1.7. And over time, that deleveraging, that I'm not going to borrow money just to have it and put it in the bank. I'm only going to borrow what I need. I'm going to pay back debt right away. I'm going to deleverage as an economy. So now, and I do this myself, I'm not carrying a big mortgage. Do you know why? I don't want to owe the money, have the moral hazard of having the money in the bank, and then I spend it. Oh, let's buy a new car. Next thing you know, I got a car payment, I got a mortgage payment, I got all these payments, right? And what if I lose my job? I'm in big trouble. So I'm going to have minimum debt. I'm going to spend less. This is going to calm down. And it's a corporate, personal, everyone's doing this. So now we have an economy with a velocity of money at 1.115. So a dollar printed only creates 11 cents of additional. First off, maybe that's because the banks aren't lending it in the first place. No, you know what they're doing with it? They're parking it at the Federal Reserve. Now, I haven't looked at this number, so last time I looked, it was like 1.4 trillion. So this is time for a surprise. Reserve repurchase agreements. Overnight reserve repurchase agreements. So Fred, again, reserve, reverse, repo. That's fine. Reverse repo. Fed, St. Louis, Fed.org. Again, these are all official websites. Thank you, Federal Reserve Bank. So let's take a look. Normally, this thing runs like 200 billion a night. Now, the reason they do this is because the banks, there's a certain amount of reserves you have to have, right? In order to be solvent, in order to be a good bank, a good steward. We're not going to be a run on the bank. It's going to be nice and solid, right? And so you have extra reserves. You took in a lot of deposits. You didn't make those loans. You took in the deposits. You didn't make those loans. So now, where do you put the money? Overnight, it's worthless. It's just sitting imagine the money is just sitting there, not earning anything. You pay interest on your deposits, but you don't earn anything. Well, that's not a good way for a bank to work. So what they do, they gather up all the money, and overnight, they collateralize that money with a thing that the Fed will take overnight and give it back to you. And that thing could be 10-year U.S. Treasuries. That's not bad. Could be a 20-year, 30-year Treasury, but probably like a 10-year Treasury. It's a solid thing that the Fed can borrow, can lend, can do this, right? So now you're giving your money to the Fed for like 6 basis points. 0.06 a year. But it's better than nothing, right? But something changed. Okay, we're going to go all the way back, as long as the data is. And there was none of it, realistically, 2004 to 2008. Now, during the debt crisis, September 2008, 26 billion. Some banks probably called in some stuff and said, all right, I got 26 billion of extra reserves. I want you to remember that number because of how ridiculously low it is. 2008 was a major crisis. So now let's go now. So this number right around February of March, really March of 2021, the banks were flush. Now, this is when the Fed probably should have stopped tapering or started tapering. I know there was a first taper tantrum, people got worried, but the Fed probably should have said, you know what, we're not going to pump 120 billion a month into the economy anymore. We're just going to stop because the banks obviously have enough money, but they didn't. So in the past, on November 5th, there was $1.35 trillion parked overnight with the Fed. Okay, that number hit a pretty good high there in October 29, right before I went Halloween trick-or-treating. By the way, I'm a huge, huge candy fan. Love candy. I gotta tell you, love candy. Just so you know that about me. Love candy. Candy bars. Crazy. Crazy for them. 1.5 trillion. 1.5 trillion parked overnight to earn 6 basis points. Extra cash. No wonder why there's inflation. No wonder why there's money. No wonder why the stock market keeps going up. Even though there's like no good news, right? $1.5 trillion parked overnight at the Fed because they're sick of having no return. How about the money that they keep as reserves that are not excess reserves? How about just the regular reserves? Right? Maybe there's $1 trillion of those. That's a lot of money. That's a lot of money. And that I want you to get a feel for this. If there's $1 trillion that the banks are holding to be within reserve requirements, and there's $1.5 trillion extra, that's $2.5 trillion, how much money is there, Jeffrey? Well, thank you for asking, right? How much money is there? There's 21 trillion. 21 trillion. So what does that mean? That means it's 10%. It's 12%. It's 12% of the money in the United States is extra. That's a lot extra. I hope that doesn't turn into inflation, because that's a problem. This is self-inflicted wound. This is printing money and putting it out there. Putting it out there. And the reason they did it was because during the pandemic, they wanted to make sure that there was money for the regular Joe and Jane that needed it. They didn't want to tighten things up right when the people were unemployed, sitting at home, worried about their dying, right? I get it. But now we're going to unwind it. So the second thing I looked at this week was I looked at interest rates. Let's go to FINRA. I like FINRA. By the way, I've had dealings now with FINRA as we're becoming a registered investment advisor. Bonds. Let's take a look at bonds. So one of the things I like to look at the government, U.S. government, federal government yield curve. And the way the yield curve works is that they have the maturity 10 years, 30 years, 5. These are all different issuances, right? Now, the funny part is if you had a 30-year bond that's 10 years old, it's a 20-year bond. So there are people that plot maturity every month, and that's fine. But for right now, this is what we got, right? So you look, it's not that steep of a curve, but if you're borrowing money for 6 months, it's 0.07%. It's 7 basis points for 6 months money. In fact, the curve inverts from 1 month to 3 months, but that's probably just rounding error. But you're talking for 5-year money, it's 1.1. For 10-year money, it's 1.53. And for 30-year money, it's 1.96. So that's not high interest rates. Those are not elevated interest rates. I would have thought if you announce that you're stopping buying bonds and that you're going to dry up the extra supply of money, that these interest rates would go up. But they've not gone up. I've been watching. In fact, they've been going down. And when I look at when Yahoo Finance talks about interest rates on the top of their page there, they're showing 1.46% 10-year yields. That is actually like really low. We look over a year, that's low. That's where it was in June. That's where it was back in February. And yeah, it was lower before. That was when you were in the bloodlust of Fed money printing, right? And so, yeah, that's not, and it looks like a downward trend, right? So interest rates are not going up. So that's good for the market, okay? That takes a lot of pressure off. So what we're finding is that the small caps are on fire again. So the Russell's up a percentage point. The NASDAQ is up 0.2. The S&P 500 is up 0.4. The Dow's up 0.5. Good for you, Dow. But point is, small caps are on fire. And in fact, I bet you if I look, small caps are really on fire. In fact, I have a plot. I hope I don't show you confidential information here. I might. No, I can't show you that. I'm sorry. Hang on a second. I can't show you this. Let me take it off screen for a minute. Oh, my cat's outside. Pawing at the door like he's worried about getting eaten by something. Where's the stuff? Model output. Here it is. You're going to love this. Now, don't take this information and use it. That's not what this is about, people. This is me showing you something. So I run this model every day now. It's awesome. I get so much information about the stock market. It is killing me. I love it. I love it. I love the stock market. I love making money in the market. So let's talk a little bit. I wonder if I made money while we're on this call here. So The actual S&P 500 return through market close November 3rd, which is Wednesday night. The S&P 500 is up 40.25%. I don't know if you realize how much money that is. If you put $1,000 into an S&P 500 fund a year ago, you have $1,400. It's a lot. Now, we could look, I'm going to get off tangent a little bit. Let's go to FinViz. I love FinViz. They have this heat map, which it is indispensable. This is the S&P 500 that you're looking at right here, but you're looking at it in a heat map form. And let's look at the S&P 500 over a year. Okay, it's almost all green, but the biggest stocks are up the most. So remember, 40.25 is your number. Tesla's up almost 200%. ExxonMobil's up almost 100%. Google's up 70%. Microsoft 55%. But then it breaks down a little bit. The big banks are up. Wells Fargo 130%. JP Morgan and Bank of America are up well over 40%. 68%, almost 100%. You know, so it's like these big companies driving a lot of this performance. NVIDIA up 116%. Accenture up 60%, 61%. So, BLK, right? So BlackRock. BlackRock, Bank of New York Mellon, State Street. The money managers are double or triple that. And so money's flowing where it flows. It's flowing into the money managers, big banks. It's flowing into the kind of the fun stocks. Where is it not flowing is, for the most part, healthcare. Healthcare, you see low double digits in terms of the benefit, the growth rates. You do see a lot in diagnostics and research because of the COVID thing, right? So look at telecom. In the toilet. Verizon and AT&T are each down almost 10% while the market's up 40%. So they are, relatively speaking, 50% cheaper than they were a year ago. Think about that. Verizon is 50% cheaper relative to the market than it was a year ago. Oh, can I tell you that we are long Verizon? And we are long Verizon because we bought it yesterday. The thing cratered yesterday. Bought it for 51 and change. It's now 52 and change. I'm up $1 in a day. Workhorse. We're up Workhorse. And then Corbis, which is one of those biotech weed stocks because they work on the cannabinoid system to try to solve things like obesity, inflammation-related diseases, DM, and other things like that. And they're working hard. It's tough, though. It's tough to do research and then successfully market a product, right? But this is what we're up, and so what we're in. But so now you have a market that is odd because those are up like, what did we say, 40% for the S&P 500. There's a reason, Jeffrey. Get to your point. The QQQ, which is your tech stocks, it's the NASDAQ 100 composite, is up 44%. So that's great. $1,000 is worth $1,440. That excludes dividends, by the way. IWM, the Russell 2000, the smallest stocks in the market, are up 50.4%. You would have gotten half return on your money. And that number has gone up the most recently. So, small caps through the roof. It is a target-rich environment. That's the name of the video. The market is target rich because the small caps are moving. Now, who buys small caps? My wife asked me this question. Jeff, who's got the money to buy small caps? Do the big banks buy small caps? I mean, they probably spread funds around. They probably open up a fund. Let's raise whatever, $10 billion. Let's buy $1 million of all these small caps, right? Fine, that's good. But I think it's individuals. I think it's people like me who are banging away on a keyboard that are on social media. They're like, oh, Corbis, underpriced, great deal. Oh, it's moving. People are in. Zach Morris likes it. PJ Matlock is all over it. I think Britney Spears' fake Twitter account really likes it. So why don't we jump on it? And what happens is you see stocks going up and down like crazy. And so small caps are easy to move if you're a bunch of small investors on a Discord channel. Now, I don't know that this is happening, but it sure looks like money flows into these stocks because it's just a game. And so I watched today. I watched Workhorse today. I'm going to show you a chart on that one. I got back in. So I bought Workhorse after an intense amount. I probably studied for 30 hours. I read all their financial statements. I looked at their product mix. I looked at all their information. I even learned on LinkedIn. I think I might have even connected with someone. I mean, it was great. Workhorse, I'm all over it. It's an Ohio-based manufacturer of C-class trucks and drones to do package delivery last mile. And they had a big bid. They went for the U.S. Postal Service. They lost to Oshkosh. But let's be honest, Oshkosh sells thousands and thousands of trucks to the federal government. I would trust them. Now, if I'm smart and I'm Workhorse, I'm subcontracting to Oshkosh. I might make less margin, but to be honest, if I could get in there, Workhorse, come on, make the trucks, make the chassis. We'll put our logo on it, wrap it up. By the way, I probably even get credit because you're a small company. Oh, I love it. All right, and by the way, are you veteran-owned? Are you woman-owned? Are you minority-owned? Oh, I'm in, right? But I don't know if they did all that. What I know is Workhorse is a solid company. And by the way, yesterday, I just want you to think about this. Yesterday, this is such good news. Yesterday, they cleared out another tranche of like $80 million of debt. Do you know they only have like $27 million of debt left? They traded $175 million approximately. That number might be a little bit different. $175 million of debt for equity. So sure, they diluted the stock. That's great, but they got money for it. They eliminated the debt. So now $27 million in debt. There's no bankruptcy risk for Workhorse. They got all the time in the world to make trucks. Smartest move in town. I love the story. It's an American innovation story. Workhorse. I even like the name. Who doesn't like a truck named Workhorse? Horse? Workhorse? You know, the person who's a workhorse, right? Carries the load. I love it. So, what happened to the stock today, Jeff? Why'd you bring it up? What do you talk about all this stuff for? All right, let's find out. Workhorse. What did they do today? So the Department of Justice launched an investigation into Workhorse. Oh, that's not good news. No, it isn't. Nobody wants to hear about a Department of Justice investigation. And so, the truth is, though, shit happens. They turned over their CFO and their CEO. Who knows? Maybe the old guys, the past guys, did something wrong. I don't know. So here's what happened to the stock. And I'll tell you when we got in and when we got out. It was kind of fun, right? So we saw the stock fall, and we bought right around here. We spent $6.31. I didn't even buy a lot. I bought 800 shares. $5,000. I actually had like 5,000 and like 10 cents in my account. So I said 795 shares. So it would be just under 5,000. And I made the purchase. And then I watched it go up and I watched it go way up and I didn't sell. Oh, I should have. That's fine. So I waited. It was so interesting, and it went down and went up, and I sold like right around here. I sold it for like $7.10. I felt like maybe I gave it away, but I thought, you know what? How do you make 10% in a week or a week and a half? No, it was like 2 days. How do you make 10% in 2 days? Done, sold, washed my hands. Stock kept going up, and you know why it went up? Because people liked the story, the Workhorse story. And the stock hit like $7.50, and I'm thinking to myself, I'm such a jerk. I sold it at $7.10. I could have made all this extra money, but I didn't. It was fine. So today I'm watching the stock, and it just dropped. Can you see that on your screen? Let me just do the 1 day, 1 minute intervals. So I think I'm on the phone or I'm doing something. I'm picking my nose. I'm looking at some article. Oh, I think I was reading Tenneco's quarterly report or something. Workhorse starts flashing. Right? I was looking like maybe I'll buy it at 7. It's not bad. I mean, I sold it at 709, maybe, whatever. And then all of a sudden I look and it's 660, 680. I'm like, oh my God. So I'm watching in the 5 minutes, 10 minutes that it collapsed. So you know what I did? I bought like crazy. I bought 1,000 shares. I bought 1,000 shares. And I bought 1,000 shares. I bought 5,000 shares, 1,000 at a pop. And then I put in an order for another 6,000 shares. But my broker said, Jeff, you're out of money. I was so psyched. I was going to spend all my money. I was going to buy like 10,000 shares, 11,000 shares. I love this stock. And I loved it at 709 when I sold it. I was like a parent giving up a child, right? Well, now I bought it back at $6.59 average price. And I love it. I think flattened out. It's fine. You know this thing's going back up. You know it's going back up because they have no debt. They have like $27 million in debt. It's an $800 million market cap. Let me look. Maybe I'm wrong. What's the market cap according to $820 million? Right? They have no debt. I love this company. How did they do it? I don't even know. And best yet, and they sold the debt at like $7 a share. So I just made 30 cents. 40 cents. Love the story. All right. So Workhorse. I like that story. Now you understand. It dropped like a rock. It was crazy. People ran for the hills. What's the next stock I own? Corbis. Now, Corbis is a sad story. Corbis is the saddest story I know. In fact, I feel like a real loser owning Corbis. Let me tell you why. I got memed. If I go back far enough, what was it, about 6 months ago, I started buying this stock. I thought, oh, look at this stock. $1.70, $2. I was like, it's great. It's a $2 stock. It's going to shoot the moon. I thought this thing was going to shoot the moon. Look at that nice upward trajectory. And the reason is that very few companies research the endocannabinoid system. It's the part of your body, like if you were a caveman and you were attacked by a bear and you're hurting, it's the part of your body that controls whether you go into shock or not. It's the part of your body that determines whether you're hungry or not, or want to drink water. It's like the subconscious part of your body that handles emergency situations. It's the part that makes you feel hungry. So, when you smoke pot, you get the munchies, right? I didn't smoke pot in years, but you talked about you'd smoke pot, you'd eat Twinkies, you'd eat pizza because you were hungry. Well, guess what? You can also make a pot of medicinal pharmaceutical quality that makes you not hungry. It's just the opposite, right? And so instead of triggering a receptor, it'll be a negative receptor. And so now you block it. So now, I'm not hungry. Well, I'm sure not going to eat candy. Probably going to eat less at dinner. I'm probably going to lose weight. I'm probably going to deal with obesity by taking an overactive sensor in my body, receptor in my body, and I'm going to change it. That's great. The other thing that this system does is it deals with your emergency response. And so you have an illness, you have an injury, and you have inflammation. So it is the endocannabinoid system that handles your inflammation. So if I can tell the body to stop pumping inflammation, I can bring down swelling, I can bring down rashes, I can cause less muscle ache. It's great. I mean, I have to use ice to do that. Imagine if I didn't have to use ice, I could just take a pill or a shot or something. Handle it. And handle the kind of inflammation that isn't because I had a boo-boo, but because my body is fighting itself as an immune response to something, and it's killing myself from inside. So that's great. I want that drug to work, right? And this is a company that has enough money to get themselves through probably another year or two of research. Lenabasum, it's been tricky. Their number one drug candidate has been tricky to get approved. And so they're working on it, whatever. Who knows whether they'll be successful or not. But this stock pops. Stock was a $2 stock not that long ago. It's $1 now. And I posted a tweet, which I'm going to share with you because I think this stock is being pegged. Now, when I went through my FINRA training, I learned what pegged means. It is an illegal action. I think someone is pegging Corbis low. They're pegging it low. So this is a tweet I sent. I don't know who would be doing it, but if I'm the SEC, I want to be watching this stuff. I want to be getting all over it. Because I think I found something, right? And I made a tweet about it. Somebody pegging the stock lower at close. So here's what happens is the stock is trading at $1.06 all day. It's a good stock. I had a good day today. It went up 2 cents, whatever. And then right at 4 o'clock, someone sells into the close and takes it down to $1.03. And then at 4:01 after hours, it's 106 again. So here's what I'm thinking. Right at the close, they sold probably 5,000 shares because I'm looking at the chart. It was very small, very little volume. So maybe it's 5,000 shares. Sold, sell at market, 5,000 shares, right? So I drive the price down. Now, what did it cost me if I'm a trader? 3 cents. Assuming that they bought it back 1 minute after hours. They bought it back at $1.06. They sold it at $1.03 and they bought it at $1.06. And they walked away a winner. It cost them $150. But that they marked the price at $1.03. So all the models, all the computer programs, everyone out there looking at closing prices would have seen a 2 cent rise in the stock and would have felt good about it. But they didn't see that. They saw $1.03. And so today was trading around $1.05 for most of the day. It's down to $1.150. I'm actually going to buy a few more shares. But someone's working on this stock. It's been since around September 17. They're managing the stock lower. And the only reason I think someone would do this, look at how flat that line is. Look at how flat that line doesn't get flat like this on purpose. I mean, by accident. Let me draw a line there. That doesn't always do it. Hang on. Draw a black line that is thick. I can't. But basically this flatness right here is not normal. It started September 17 when the price was driven down from $1.13 to $1.02. And it's been riding there pretty much ever since. And there's some good volume. So what I'm thinking is there's an accumulation going on because this stock will pop again. It will go up again. It will go up. I mean, it's my opinion, right? And look, you look at this, right? Some of the volume metrics, accumulation's up. The RSI isn't that low. It's at 45. The stats don't lie. I think this stock is being accumulated. The stock has shown the ability to be pumped from $1 to $4. I mean, call it $3. $1 to $3. You could triple your money. Triple bagger. So that's what I see on Corbis. Now, I like the fact that they're doing the endocannabinoid system stuff, but trust me, I didn't sell the stock because I think it's got real potential. The third stock I own is Verizon. What do I like about Verizon? To be honest, the model likes Verizon. The Chicago Quantum Net Score loves Verizon. Loves it. It's been loving it now for about 3 months. The model keeps picking Verizon higher and higher. I want to say it was like the 50th best stock out of 3,100. So it's got low volatility of price. It's actually got some kurtosis. It's leptokurtic. So what that means is it can jump when you don't expect it, right? So Verizon can move. Look at those moves. Moves down. Doesn't matter. It moves. It moves sharply. That's not normal. Okay? For a utility company that has a 5% dividend. Not normal. Okay, so it jerks and it moves and it explodes in price movement. But overall, it's very low volatility. It doesn't move that much. I mean, you can watch it for a week and it moved like 1% a day. Look, today it's up 1%. I bet you today it's going to close. It's going to be up like 0.5%. And so this is a stock with very cheap options because low volatility, but an ability to pop. And I love a 5% yield. And this is a bet the bank business because they owe, I want to say it's $180 billion. They're worth $220. So the whole company is a $400 billion value company. All the market value of the debt plus the equity is $400. But they're spending like $65 billion on a 5G network, on a C-band 5G network, brand new. And that means the cell phones are going to be new. And they're going to have home internet service. Gigabit per second internet service. Can you imagine? I spend $190 a month on my home internet service, and I get like, I don't even know what I get. It's not a gig. It's like it's like maybe 100 meg. Okay? So I could save money, move to Verizon. Verizon becomes the #1 network company in the world, in the United States, with the best network, the best customer experience, according to the CEO in the last earnings call. So I like it. It's a bet the business kind of a thing. But they're betting on investing in hard capital for a new network. I love it. They bought the licenses, they got the spectrum, and now they're putting in the effort, the money, the time, the effort, the expertise to build out this network. So in the United States, the best network will be Verizon. Now AT&T may be doing the same thing. I don't know. I don't talk about their competitors. But all I can say is, sure looks good. I like a company that's investing, not just firing people, but investing in the future, capital investment, creating a moat of value. But something happened yesterday. Same thing. That's why I say target-rich environment. You got to be watching this stuff. If you're interested, so if you were to run if you were a client of ours and you got the model, let's say every day, that'd be expensive. I get it every day. I love it. But it'd be expensive for most people, right? But if you got it, you would have been like, Verizon. Oh, another day when Verizon comes even higher. By the way, the Canadian banks are in our model right now, and those are dogs. Semiconductors and Bitcoin miners came up about a month ago, and I got to tell you, because I tweeted a lot on it at the time, you can follow Chicago_Quantum, see the tweets. Semiconductors and Bitcoin miners are through the roof. I get emails, all-time highs. Every day I'm getting an email now from Yahoo Finance. This one hit an all-time high. Brooks Automation, Applied Materials, Lattice, all these guys. Boom, 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 up. Well, we picked them all. The model picked them all before they went up. I love this model. So let's say you had it every day and you're like, Verizon. Well, sure, when Verizon's like flat, I don't know that I want to buy it. It's not compelling at 54. It's not bad. It sure isn't great at 60, right? So I don't know what to do, Jeffrey. Maybe I zoom in for a month. I mean, if you were smart, you bought it here on 10.13. But you better move fast because on 10.11, it opened at 53 and change. What did it open at? 53.26. See, I had like 4 days to buy, but I think I was on vacation or something, right? So I didn't see it. So now it's back up again. Now you got to make a decision, right? At a high of 53.93. I don't know that I want to spend $54 on Verizon. So I watch and I watch and I watch and I watch and boom, this is it. This is the day. What day was that? It's yesterday, November 4th. So let's zoom in. 5 days, November 4, what happened? Can you see this? By the way, am I just talking to myself or is there anybody out there watching? I don't know. I might just be talking to myself. But if you actually get value out of this, hit the like button, hit the thumbs up button on the video, subscribe, even better. Let me know you liked it because I'm fascinated by this stuff and I want to know that you are too, or else why am I doing this, right? I'm doing it for you people. So stock drop. Love it. I love that it came down like this. So if you were watching, you jumped in. Boom. Now, why did it drop? The FAA, so the FCC said go. The FAA said no. You might be affecting the communication between aircraft controllers and aircraft, and between aircraft and the little thing that tells it how high off the ground it is. That's a problem, because if you can't see the ground, you trust your instruments. There was a movie about this, a Bruce Willis, Die Hard. I think the last Die Hard was at an airport. It was Christmas. It was snowing at the airport, and they actually recalibrated that piece of equipment at O'Hare Airport. In the movie, it was fiction, thankfully. But in this case, they're saying maybe this will interfere with that one piece of equipment that sends up the signal to the airplane to tell it how high off the ground it is. So they said 30 days, they'll delay the rollout. AT&T and Verizon. Now, I get it. 30 days delay is probably going to cost them $10 million in profit, $20 million in profit, $50 million in profit. But that's not enough to take the stock from 53 to 51. They have 4 billion shares. When it drops $1, that's $4 billion. That's a lot of money. So I bought like a drunken sailor. I've never bought that much stock in my life on that kind of hunch, but I did it because the model liked it. And then I went in and I bought options. I'm sorry to my client who likes me to buy and sell options, but I can't. I looked today and I'm not comfortable, right? So I bought the longs when I bought the stock. For every 1 share of stock I bought, I got about 4 calls. 4 stocks with a call. So if this stock goes up to $55 a share, you're going to see a very professional backdrop, because I'm not going to need the bookshelves that I got at Home Depot and installed myself. You can have nice bookshelves. But the point is, not my bookshelves. The point is, you're watching. A model gives you a signal. Look at these stocks, okay? Then you watch them during the day, and when they pop like this, you jump in. So how are we doing? So at the end of the day, what did I tell you? I told you that I'm in Corbis because it is a dog stock. Dog. It's beaten down. It can go low or it can go bankrupt, but I don't think it is. I think it's going to go up. You got Verizon that I bought yesterday. I'm up a lot of money on Verizon. I love Verizon. It's great. Plus, I'm getting 5% dividend while I wait. And on the calls, I can exercise them early. They're in the money. I can exercise them early, and I could get the dividend, or I could sell the calls, and I can buy the stock and get the dividend. It's a juicy dividend at 5%. And I've just locked in a purchase price that is beyond meat. I mean, it's awesome. I got the calls here. The calls are up 12% just today. I mean, that's nice money right there. And Workhorse is at 658. And so Workhorse, in fact, you know what I'm going to do? I'm going to show you how the 3 stocks work today. Put them on a chart together for you. Now, these are not stocks that you should buy, but this is a way to think about investing. This is like a fast-moving kind of a thing here. Except for Corbis, which is a long-term dog that I own and I can't seem to get rid of. In fact, today I bought more. Why would you buy more of a dog poop stock? Well, because it's $1.50, and I'm about to buy more when I hang up this call. So, but you take a look and you see Workhorse dropped way down, some in. Verizon just kind of flows with the wind, and you get your 5% dividend. I like it. And then here's the other one. Here's Corbis, just kind of up and down, but still pretty flat. And so what I like about the model is it's picking stocks where I don't lose all my money in one night. I don't wake up in the morning and panic. I get less volatility than the average Joe. And I get more potential or expected return. So I get more gain and less pain based on last year's data, right? The future doesn't always play like it plays last year. But let me show you the model. By the way, I love candy. Halloween candy. Can you believe it? I went out Halloween trick-or-treating. I was dressed as a monkey. And I went out with the kids. I had so much fun. The wife went with me. It was great. It's a baseball. So if I throw this baseball, what do you think is going to happen? Watch. You ready? I'm going to throw the baseball. You ready? Watch. Careful. Throw. So what happened? Well, now it's bouncing around and it stopped. But for the first second after I threw it, after I released it, it moved in the same direction. You could predict the flight of that baseball very accurately for the first 1/100th of a second after I released it. And so basically it's moving in a straight line trajectory for 10% of the time that it was in the air. Now it's on the floor. It may roll left, roll right. You can't really predict. But for that first moment. And so my stock model is to take the year's worth of data and predict the next 10%. 25 days. And it shows predictive power. That's awesome. I'm not saying whether it's going to go up or down. What I'm saying is it efficient? Is there a lower variance per expected return unit? If the answer is yes, it means watch it. Do your due diligence. Because if you buy it, you're probably going to be okay, especially if you buy it after it goes down. So I do that a lot. I miss a lot of runners. But if I watch a stock and it goes down and I'm like, oh, it's an even better price. And I've done all my due diligence and I've read every SEC filing and I'm looking at all the advertising, then I'm good. So this is what's going on. So let's recap. Number one, we have inflation, but I believe it's oil price driven. And it's driven by Fed monetary easing. Number two, the Fed is going to start to unwind or tapering down the bond purchases, which should remove all of the drivers to M2 growth. So the Fed, if they do it right, could actually eliminate the inflationary fuel on the fire, the fuel to the fire. They could stop pouring gasoline, $1.44 trillion of gasoline on that fire per year. That's nice. Don't stop doing that. That's helpful. Bond rates are low, lower than I would expect, lower than they were 2 weeks ago. Bonds yields are lower. That's good for stocks. It's good for utility stocks, right? And last but not least, you kind of have to watch the stocks that you like, because I realized this. I was holding the same stocks for like 6 months. They'd go up. I'd feel so happy. They'd go down. I wasn't that happy. Up and down, and there I rode like a roller coaster ride. So now, stock goes up, I'm more likely to sell. Now, right now I don't want to sell Verizon, I don't want to sell Corbis, and I don't want to sell Workhorse. I like them. But come next week, if they move and I make more than lunch money, I'm probably going to take my profit, and I'm going to wait for the next stock. So that's what's going on. Target-rich environment, the powers that be are taking action, and you now know the case for why I'm in the 3 stocks that I'm in. And I want to thank you for listening. Have a great day. Bye-bye.